My name is Jake, welcome to the channel. In today's video, I want to talk about what every dividend investor should know about managing risk. And really, this video is centered around newer or beginner investors. And I'm going to focus on two main things in this video. I'm going to focus on what is risk and how to manage risk as a new investor, particularly those that are interested in investing in a dividend growth strategy, that which I talk about on my channel. What you can see here on your screen is the weak performance of the broader market. And if you are like me and invest into the stock market, your portfolio may look similar to this. And I am no different. In my M1 Finance portfolio, my account has never been this low, and it's been kind of a roller coaster. But as you can see here, I am not immune to this. Despite investing into companies that are a little bit more conservative, maybe like a Disney or a Dividend Aristocrat, a company that has paid a dividend for consecutively for 25 years, a lot of these companies are still down. And I'll be honest, as a dividend growth investor, I get really excited about this. I get excited when I see that McDonald's and Union Pacific are down, because that means that I get to buy into these wonderful businesses at a discount, and I get to increase my yield on cost. And what I mean by yield on cost, for those of you that have followed the channel, you know that my portfolio, if you go back and you look at my previous videos, when I share this screen here with my overall portfolio, my dividend yield for the last couple of weeks has averaged right under 2.5%, about 2.4%. And with this market pullback, my dividend portfolio is now yielding 2.77%. And as a dividend growth investor, I get incredibly excited about this, because this yield on cost, by buying into the market, I immediately increase my yield on cost. And that is why I love buying into wonderful businesses, quality companies that are growing, that have an economic moat, that have a sustainable business model. I love buying into these companies, and I love buying on down days like this, because I get to increase my yield on cost. Now, before I dive into the two things that I want to focus on in this video, what is risk and how to manage risk, I want to show everyone very quickly in my own portfolio how I took advantage of this dip. I know a lot of investors are talking, there's a lot of fear in the market, and I want to share with everyone that I am still buying. I'm putting my money where my mouth is. In addition to my weekly transfers, I transfer weekly into my portfolio, and through the dynamic rebalancing, M1 Finance automatically purchases into my underweight holdings. But on Friday, what I did is I transferred, in addition to my weekly transfers, I transferred over $1,000 into my portfolio, because I wanted to take advantage of this market pullback. And now I'll be the first to say the market very well likely go down next week and in the weeks to come. And I will continue to dollar cost average into my portfolio. But with this the $1,000 that I invested, in addition to the $100 weekly transfer, I purchased companies like Pepsi, Disney, Ecolab, we can go down here, Target, Visa, Walmart, Union Pacific, Honeywell, a lot of these companies that you may be familiar with Apple, Hershey's, Intel, Microsoft, Wells Fargo, Caterpillar, the list goes on and on. And so I am buying into the market. I'm using this opportunity to increase my yield on cost. I think when it comes to risk, a lot of people, whether they're professional investors, new investors, we try to look into our crystal ball and forecast what's going to happen in the future. And by doing this, I think it's important to understand that, yes, you can do it. It's a human thing to do so. However, I think the actual impact that it has on our decision making and the results of the performance of our portfolio is really actually very minimal. And Jack Bogle, the founder of Vanguard, has a great way of putting this.
Look, you're young and I'm old and experienced, and neither of us have any idea the outcome of the big risks that we all face today. Nuclear war, religious war, global warming, trade wars, pandemics, the breakdown of governance in our country. You can name a lot more, and every one of them is worrisome.
No one truly knows what's going to happen in the future. No one knows how the market is going to react. No one knows when the next market recession will be, the next bull market. We can look at different things like interest rates and try to forecast, but no one truly knows. And I love this quote from Benjamin Graham that successful investing is about managing risk, not avoiding it. So in order to manage risk, we have to understand what risk is. And I think there's no better person to explain this than Warren Buffett. There was a question asked to Warren Buffett back in 1994 at their Berkshire shareholder meeting, and it was specifically around risk. What is risk? And the clip that I want to share is a little bit older, back from 1994. The clip that I'm going to share is just over 2 minutes. And I'm going to share a link to the source in the description. So if you want to check out that entire clip, you're welcome to do so. But this is how Warren Buffett describes risk.
We do define risk as the possibility of harm or injury, and in that respect, we think it's inextricably wound up in your time horizon for holding an asset. I mean, if your risk is that if you intend to buy XYZ Corporation at 11:30 this morning and sell it out before the close today, I mean, that is, in our view, that is a very risky transaction, because we think 50% of the time you're going to suffer some harm or injury. If you have a time horizon on a business, we think that the risk of buying something like Coca-Cola at the price we bought it at a few years ago is so close to nil in terms of our prospective holding period. But if you ask me the risk of buying Coca-Cola this morning and you're going to sell it tomorrow morning, I say that's a very risky transaction. Now, as I pointed out in the annual report, it became very fashionable in the academic world, and then that spilled over into the financial markets, to define risk in terms of volatility, of which beta became a measure. But that is no measure of risk. The risk in terms of our super cat business is not that we lose money in any given year. We know we're going to lose money in some given day, that is for certain, and we're extremely likely to lose money in a given year. Our time horizon of writing that business, would be at least a decade, and we think the probability of losing money over a decade is low. So we feel that in terms of our horizon of investment, that is not a risky business, and it's a whole lot less risky than writing something that's much more predictable. The interesting thing is that using conventional measures of risk, something whose return varies from year to year between plus 20% and plus 80% is riskier as defined than something whose return is 5% a year every year. We just think the financial world has gone haywire in terms of measures of risk.
So risk, according to Warren Buffett, is described not only by volatility, and in this case, the financial world phrases this or terms this as beta, but also really the time horizon in which you're investing and what you're looking at. If you're looking to buy something at 11:30 in the morning and then sell it the end of close that day, that is very risky in terms of how Warren Buffett views risk. What is beta? I think that's important to understand. The financial market terms risk as in terms of volatility and beta. So what is beta? Beta is a coefficient which measures the volatility of the stock market's returns relative to the market, the S&P 500. So the average would be the market, and the market is at 1. Okay, and so if something is below 1, that would mean by definition there's less volatility, a lower beta. That would mean less volatility equals less risk. Okay, anything above 1 would then be the opposite and would be considered more volatile and therefore more risky. Okay, so let's take a look at it a few. So if you were to look at VOO, that's the S&P 500 from Vanguard, that has a beta of 1. If we were to look at Tesla, for example, Tesla has a beta of the last 24 months of just under 1.5. So very, very volatile, and therefore, in this case, risky. Another scenario would be with McDonald's. McDonald's, the last 24 months, McDonald's beta has been under 0.5. So by definition, less risky, less volatile. But I want to mention though that McDonald's, as you saw in my portfolio in the beginning of the video, McDonald's is also down. Just because a company has a low beta does not make the company immune to market corrections. Okay, so very, very important to understand. So as a new investor, a way that you can shield yourself from risk is by lowering the volatility within your investments. Now, I believe that, this is just one aspect of it, okay? Now, looking at the beta in terms of the volatility, as well as the time horizon which you're investing in. Now, if, we talked about McDonald's and we talked about Tesla. Now, if we take Warren Buffett's approach, if we were to invest in both of these, we're gonna have lower risk the longer that we hold them. Okay, so those are just things that you can consider when you're first starting out in investing, right? And understanding what is risk and how do you manage that. Another way that you can manage risk is through proper diversification. Now, diversification can mean a few different things. It could be you're investing into different types of businesses, different individual companies, ETFs, you're investing into different countries. Maybe you're not just investing here in the US, but also internationally. You're investing into different asset classes, whether it be in short-term investments, treasury bonds, long-term, stocks, all those different things. So understanding, okay, is my portfolio diversified? Okay, and then in my portfolio, one way that I diversify here in my M1 Finance account is through investing into different sectors. Okay, and my target allocation is set up more towards a growth model, but also a conservative defensive growth in having a higher target allocation into consumer staples and industrials. Another way that you can manage your risk in your portfolio is looking at the payout ratio and understanding what the payout ratio is. Now, on my channel, I don't go really deep into the fundamentals, look into the balance sheets and the income statements of the investments that I hold. I do that in my own personal research as I'm investing and researching into companies and following up on companies. But the most important thing is that you understand the payout ratio. The payout ratio is from a company, the way that it's figured is the company's net income. What percentage of a company's net income are they paying out into their shareholders in the form of a dividend? Okay, and the payout ratio is really going to depend on the sector, the business, and the company. Okay, so traditionally, if it's an industrial company, a consumer staples company, I want to see a payout ratio ideally under 60%. Now, if it's a growth company like an Apple, a Microsoft, or Texas Instruments, for example, I would like to see it under 30%, right around 30 or below. Now, if it's a utility company like a Dominion or a Duke or a Southern Company, I think it's okay to have a higher payout ratio, for example, in the high 70s or even low 80s. I think that is completely fine. So these are just a few examples of how you as a dividend investor, a do-it-yourself investor, can manage your risk, through proper diversification, understanding the payout ratio, understanding what is beta, how you can work around that, and also looking at your time horizon. Now, I'm going to say that when you're investing into dividend-paying companies, a lot of people think that it is a safe haven, which in most cases, or in a lot of cases it is, but also when you're investing into dividend-paying companies, there are also other risks associated with that. Dividend-paying companies are not immune to market conditions. What all the entire global economy is facing, they're not immune to that. And in a lot of cases, great high-quality dividend-paying companies are prepared. They have an economic moat. They're secured and ready. They have great management, but they're not immune. And I know that there's going to be one or two people watching the video that are not going to listen, and they're not going to follow these ways to manage risk, and they're going to go off and do their own thing, and that's completely fine. It happens all the time.
I eat a fish.
I understand you eat the fish. But when you clean the fish, you can't just leave the fish head and guts and shit in the sink because the whole house smells like a bait station. So you gotta put it in the trash and then take the trash out. Do you understand?
Yes, I eat the fish.
Mother...
All right, comment below if you know what series that's from. When I talk about growing your portfolio and when I talk about managing risk, understand that dividend paying companies, there's also risks associated to that. And you want to make sure that you're investing into high quality companies, companies that are growing, that have an economic moat and are growing their dividend. That's what I talk about on the channel. And when I talk about focusing on companies that are of high quality, really the companies that I'm starting with are with the dividend aristocrats, companies that have consecutively increased their dividend over the last 25 years. And what I'm really looking for are high quality companies with a long-term plan. That's really the key here. And when we come back to what Warren Buffett was talking about, how he views risk and what is risk to him, it boils down to time horizon. If you're looking to invest and trade, buy and sell in the short term, that is by definition risky. In addition to, the whole volatility with beta, as we talked about in this video. But for me, the volatility, that plays a role, but the long-term aspect, that is really what I focus on as a dividend growth investor. My goal is to minimize my risk as much as I can. As we heard from Jack Bogle, no one can truly forecast and predict the future. So what I try to focus on is controlling what I can control and invest with a long-term mindset. And I think it's easier said than done to invest with a time horizon, investing in with a time frame of decades. I don't know if I'm quite there yet, but I'm trying to wire my brain to think like that. And I've noticed as I've shifted my mindset in terms of thinking long-term and investing long-term, this has really impacted my decision-making in terms of which companies I'm holding into my portfolio and really looking at it from not just in terms of weeks and months and in some cases years, but also long-term. And I'm trying, what I talk about on my channel is really the focus of the channel is to help new investors to grow cash flow or passive income through dividend growth investing. That's what I'm talking about on the channel. This is not a get quick win strategy. This is a long-term strategy, as we've seen and we've heard from Warren Buffett. And by doing so, I'm directly lowering my risk because my time horizon is not on the short term, but long term. And there by default, I'm reducing my risk. Okay. And I've noticed that as well as in terms of, I've used many different brokerages. I've used TD Ameritrade, I've used Scottrade, I've used Fidelity, I've used E-Trade, I've used Robinhood. And I've noticed with M1 Finance, it's really not a buy and sell platform. It forces you to invest and to change your mindset and to invest for the long term. I absolutely love using M1 Finance. I have not been asked by M1 Finance to create videos on their behalf. I just am an avid user of their platform. I do have an affiliate link in the description. If you are interested in signing up with M1 Finance, you can use the link below. It does support the channel. It supports me. I look at, when I first started creating videos on YouTube, I thought, okay, this is just, something that you do on the side and it's very quick. What I've noticed is in preparing for these videos, it's not actually, it does take time. I mean, when I look at the average time that it takes me to create these videos, from research to looking on, okay, how do I want to structure the videos? It takes anywhere from like 8 to 10 hours. Now, it could be that I'm just really slow, but who knows? Thank you everybody for supporting the channel. If you liked the video, hit the like button. If you're new to the channel, subscribe. I share videos like this every single week on dividend growth investing, and I'll catch everybody in the next video.